U.S. bond markets are flashing fresh warning signs as long-term Treasury yields climb to their highest levels since the global financial crisis, while rising oil prices and sticky inflation have added pressure to markets. Analysts at Bank of America say that the growing concern over America's worsening fiscal health are now becoming a major trigger behind the sell-off. Here's more.
The US bond market is witnessing a sharp sell-off. Long-term Treasury yields have climbed to their highest levels since the 2008 financial crisis. According to Bank of America, investors are increasingly worried not just about inflation and high oil prices, but also about the deteriorating fiscal health of the United States. The benchmark 30-year Treasury yield touched 5.18% this week, the highest level since 2007. And this comes as markets reacted to strong consumer spending, resilient labor data, and ongoing geopolitical tensions linked to the Iran conflict.
And the longer that oil prices stay up, the longer we're going to have rising inflation. And this is the first time we've really seen the 10-year inflation expectations cross 2.5%. And historically, that's been very consistent with a period where the Fed has had to increase interest rates. So you're really seeing a sell-off in small caps, consumer discretionary, anything that's more risk-oriented, and you're seeing a rotation into companies that have better balance sheets.
Bank of America says the return of so-called bond vigilantes is becoming evident. And these are investors who sell government bonds in protest against rising deficits and excessive borrowing. Analysts say the recent steep rise in long-term yields suggests markets are demanding higher compensation to hold US debt. Typically, stronger inflation and economic growth would push up short-term yields as markets price in more Federal Reserve rate hikes. But this time, the yield curve has steepened, with long-term bond yields rising faster than short-term rates. According to Bank of America, that signals fiscal concerns are now overtaking monetary policy as the key driver of the bond market sell-off. The US government is expected to issue more debt than previously projected as weaker cash flows and larger tax refunds widen the deficit. At the same time, higher yields are increasing the government's borrowing costs. The Committee for a Responsible Federal Budget estimates that if current rates remain elevated, US debt could rise by an additional $2 trillion over the next decade. Interest payments alone are projected to climb from $970 billion in 2025 to $2.5 trillion by 2036, consuming nearly 30% of federal revenues. Recent Treasury auctions are also signaling weakening investor appetite for long-term US debt. Analysts say investors are increasingly cautious about locking money into long-duration bonds. Bank of America also warned that the Federal Reserve could face mounting political pressure if inflation remains elevated and further rate hikes become necessary. While markets still believe the Fed remains focused on price stability, analysts say tighter monetary policy could worsen America's fiscal position by sharply increasing debt servicing costs. Treasury Secretary Scott Bessent has argued that the current oil-driven inflation shock will eventually fade as global energy supply rises. But bond investors remain unconvinced for now. Business Bureau, WION World is One.